Thank you. Not sure how many UT fans are here, but my old boss told me, when in Rome, do as the Romans. So I made sure I got me one of these Rocky Top t-shirts. Now, before we get started, I do have a question, because there is a connection between kind of New York, where I'm from, and also what I consider my favorite basketball player of all time. And he also just happened to be, I would say, one of the best basketball players in volunteer history. Now, if you can tell me who that person is, you come to New York, I'll treat you for a pizza. So, anybody? Bam. Right? 53, he comes to New York, puts on that 30. Hey, the best years of my kind of New York Knicks kind of fandom, right? That period there. Love the guy. So just kind of wanted to let you guys know. I guess something that's kind of been on my mind for the past 18 months or so, maybe a little bit longer. In January, I'm a huge fan of Professor Edward Altman. Love his distressed investing stuff, what he puts out, et cetera, et cetera. Title of his presentation, kind of where are we in the credit cycle? He said his view was, okay, it's pretty benign, we're okay. Then in February, I went to another presentation, Columbia Private Equity Program. This guy from Blackstone sat up there, chief investment officer. Question came up, what keeps you up at night? His answer was, this credit cycle is different. Then I sat in my chair, and then I just said, he didn't just say that, did he? There has to be something that keeps him awake at night. What am I missing? Unemployment is low, right? Interest rates are low. Defaults are low, right? There's a lot of positives out there, but just something inside of me feels like it can't be different. It's something. We've been going at this thing for about 10 years now. It's got to end somewhere. But where is that point? What's out there? What am I missing? So what I'd like to do today is, because we're a small group, I'm going to throw it out there to you guys. What am I missing? What is it? Right? Or is it like my former boss told me, trust your gut? Trust your gut. What does your gut tell you? We can all do spreadsheets. We can all do the math. We can all do these nice little formulas and everything else. We can make the math work, right? I can do a DCF. I can make it look great. You could look at that same thing and come up with it. You can make your numbers work, right? So what is it? What am I missing? Why do I feel like, yeah, okay, I see it with my eyes, but something inside of me just doesn't believe it? What's so different? He said there's plenty of liquidity, right? Plenty of liquidity. Interest rates are low. Right? Corporations got this tax benefit early this year, right? And my thought around that was, yeah, that's great, it's fine, but it's a one-time impact. What happens next? If it's about long-term cash flows, that's a one-time effect, right? Companies have to be able to generate long-term cash flows. So what is it? What am I missing? What am I missing? Should I be, everything's fine? It's okay. There's nothing to worry about.
Just a little stockbroker.
Manny, what I'm hearing is that there's been a shift in where the debt is located, with it being the lower quality expansion, $1 trillion worth of below investment grade credits that might be getting out over their skis with interest rates going up as quickly as they are, and that could cause a cascading effect of defaults like we've not seen.
Okay. Okay. What else? Okay. One of the things that I find interesting and fascinating is that, you come across different people, different banks. Because I was formerly at UBS, kind of the other Swiss bank, Credit Suisse, we kind of look down on them a little bit. I was talking to a guy there, leverage finance guy, and he was very proud of the fact that they did the debt underwriting for KKR when they acquired BMC. And at UBS, we were always very conscientious of the leverage lending guidelines, leverage lending guidelines, leverage lending guidelines. I think the deal got done north of 7 times. What's the Fed doing? How are they allowing deals to get done at 7 times leverage? How? And how is a bank, an institution like Credit Suisse getting it done? Does that make sense? Does that amount of leverage make sense? What do you think?
No. I think a lot of companies have way too much leverage, helped by having low interest rates. And if rates change, it's going to be a good deal.
Okay. What do you think?
One of the things that I'm most concerned about is the government pension plans in states, Illinois, California, Kentucky. We have a lot of states with huge problems that they can't take care of by printing more money because they have a printing press. And I think it's going to hit,
Yeah.
it could be a source of a huge problem.
There was one of my former colleagues at UBS. He worked on the rates desk, and we were talking, and for him, business was good, et cetera, et cetera. He had been with UBS for 9 years, and what was very interesting to me was he made the comment, I have never been through a credit crisis. I have never been in an environment where now interest rates suddenly go up. I don't know what to do or what to expect. And I thought that was, wow. Wow. Now, I'm embarrassed to tell you guys this, but I gotta let you know, when I first started out, it was probably right around Enron, WorldCom, and that kind of debacle. And I remember being on a bank call, and some guy brought up about this barges. I was like, what is this guy talking about, barges? Then all of a sudden, the guy was like, kept asking questions, and then they said, well, let's take this offline. And I was like, wow, that's kind of strange. So I walked into my boss's office. I said, man, this conversation come up kind of snarky there, blah, blah, blah. And at the same time, I was talking to my uncle. He was a big investor, liked to be in the stock market. I said, oh, man, you got to do Enron, got to do Enron, got to do Enron. It's blah, 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 blah. But I was so eager at that time and so new that I had no context of, okay, this guy left, some management changes. It came down to that, and I really didn't understand their business model. Their business model had changed. And it triggered something else that another colleague of mine at UBS, we were talking, and he was just like, we were talking about Enron, we were talking about some other things, and he said there were a lot of people at the firm that didn't understand their business. It had changed. And then it was just like, wow. So I guess in this type of environment, one of the things I kind of go back to is making sure I understand the business. Whatever company I'm looking at, I want to make sure I understand the business, right? Part of it, I agree with you, yes. Leverage in that, let's say, single B space is definitely going up. One thing I've also noticed is covenants. Isn't that supposed to protect me as a lender, as a creditor? Right? That's what they're there for, to protect us, right? Right? It's a warning signal. Something's gone wrong. But then you kind of go through the analysis and you look, and certain credit agreements allow for this, that, et cetera. So yeah, if you allow for all these EBITDA add backs and adjustments, are they really, am I really in a position to do anything or to capture this company if it starts to fall? I don't think so. So it kind of goes back to what Professor Altman, when he mentioned earlier this year that, you know, kind of defaults are low, kind of credit cycle's pretty benign. Well, that's a function of it, why kind of default rates are kind of at their lows. But for that chief investment officer at Blackstone, I was like sitting there like, give me something, I'm here, tell me what I should be concerned with, what should I be worried about? Everything is fine, right? But we know different. Am I correct? We know different. We know that at some point the music stops and there's a correction. Now, how far that goes, it's anybody's guess. But we know, we can't predict the timing of it. We wish we had crystal balls. We wish we had these things that could tell us when, but we don't. So I think now, in this environment, we have to be even more diligent and even more careful. What are some things that you don't feel comfortable about? And be ready to act on that intuition, right? Because at the end of the day, to me, it comes down to a gut feel. What is my gut telling me? And, you know, it's just, I guess it's never kind of the big thing. It's never one big thing that kind of tips the scales. It's always a little here, a little there, a little here, a little there, right? And I think people are in general focused on kind of what's that next big thing? Are we in a bubble? Are we not? Well, maybe it's something small. Now, I have to admit that in January, I was like, okay, we're in for it. This is it. This is it, right? Nothing happened. Then when I heard the guy in February, I said, okay, this is really it, because that really spooked me. This is it. Nothing happened. The market kind of goes up, then it comes down, then it comes up, right? But nothing is really kind of, then we hear all this trade talk between China and the US, nothing has happened. Now, I have to admit, I could be wrong, right? That's just the nature of the game. I could be wrong. Maybe it's my credit hat that I've been wearing now for the past 20 years that, hey, we're always trained to kind of look for the downside, right? Because unlike an equity investor, I don't get to participate in the up. I'm always looking at the downside. What's my downside risk? What's my downside? If I lend you $100, I want that $100 back, right? You want that money back. So I'm throwing it out there, right? Now, I do have, okay, I have to say this. I enjoy conversation. My wife will tell you I love to talk, but I also like to meet people, and I like to hear different views and opinions, right? Because if I knew all the answers, I'd probably be in Silicon Valley somewhere and living the life, but I'm here, right? Sitting on $1 billion somewhere. But I'm just like all of you here. I want answers.
To me, it's like a psychological change. There's never any, things work until they don't. And there's just something that trips in people's minds that all of a sudden they lose faith. And it's not, like you said, one big thing. And it can't ever really point out what exactly the little thing was that did it. But it's when the psychology changes that all of a sudden it's a big change. And one of the previous real estate crashes prior to that, I was an originator, and things started, as you were talking about, the credit started getting more and more stretched. And so we came to our boss and said, these deals don't make any sense. And they said, well, we really didn't hire you not to do deals. So, you can either do deals or we'll find somebody to do it. And, you knew at some point it was going to end, but what do you do with that?
Yeah. It's interesting that you mentioned that, because in my new role at Mizuho, and I should have put this out there before, the views and opinions, what I'm saying here today is those of my own, don't reflect kind of Mizuho, right? Kind of this credit structuring and solutions. Now my job is to sell the credit to credit. So it's very interesting to be on the kind of the other side. But I can, in general, kind of anticipate their questions and concerns and kind of walk them through. But I do find kind of some of my colleagues, and it was interesting, we were having this conversation about the auto sector and auto suppliers in particular, and the guy was talking, he said, kind of, we're trying to develop a house view on the automotive and automotive suppliers. And again, kind of they've had their issues. We're kind of 10 years out. And he was just like, it's great, everything is fine. I don't see any problems with any auto suppliers. They're in good shape. And I always cringe when I hear people say, it's different. It's different. It's different. It's different. It's different. Pre-crisis in 2008, we heard it's different. This time it's different. So whenever I hear that, I cringe. And I was just like, why? Why did you just say that? Right? It's different. Because we learn, it's just almost like the laws of gravity. Right? Go ahead.
You brought up a good topic in the deterioration of loan and bond covenants, and you've obviously lived and worked through 01, 07, 08, 09. How do you compare the covenant situation today to those prior periods?
It's a lot different, and I think it's a function of well, private equity has played a huge part. They have a lot of capital that needs to be deployed. And I think it's a combination of two things. One, of course, they want to get the best terms as possible. So they have no problem. I'm coming to you, I'm coming to you, I'm coming to you. Whoever gives me the best price, best terms, okay, let's go with it, right? Me as an investment bank, I want that money, right? I want that deal income. So yeah, I'll stretch, right? And I'll push it through, right? So I think it's a combination of both parties saying, well, let's see how far we can push the envelope. I think the Fed did something nice when they said, okay, well, here are these leveraged lending guidelines, and you have to stick with it. You have to demonstrate that you can pay at least 50% of your debt down within the I think it's like 5-7 years or something like that. I think that was a positive. But then kind of I would say once the word came out that the Fed was okay with kind of relaxing some of those leveraged lending guidelines, now you're seeing 7. And like I said, the guy at Credit Suisse, he was really proud of himself because he was just like, yeah, well, we were the lead bank and blah, 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 et cetera, et cetera. And, yes, leverage was 7.5 times, but we got it down to 7.25. What's the difference? So I give you, okay, so you gave them a little bit, you allowed for maybe an EBITDA add back adjustment that gets it down to 7.25 from 7.5. When things are good, it's like you brought up. No problem, right? We'll get it through. If the economics are there, we'll get it through. I just did one, and although I was like, oh man, I'm not sure about this, the economics were there. If I could justify the economics, okay, we're doing this deal. Right? And my credit colleague, he was just like questioning me. And I was like, look, dude, the economics are there. So as long as the money's flowing, nobody has a problem. It's when things start to get bad that then things will start tightening up again, which happened after the crisis. Then people started, then, okay, we got a little further down the road, more people got comfortable, then, okay, let's loosen up the spigot a little bit. Let's relax some of the terms.
So you'd say that covenants are worse today from an investor perspective?
Yeah,
than
yep.
06?
And it's interesting, you'll get pockets where people will push back, but not as much as, in my opinion, that they should, right?
I was listening to Tag talk about, the mindset change, and I can remember talking with one of our clients last year where he's in the hospitality industry, looking to build out a lot of hotels, and based off of their own internal calculations, they were expecting a major market correction between 2018 and 2020. So as we were planning out in the future, he said, I'm looking to slow down in 2018. He said 2019, we've been doing 8 or 10 hotels. Maybe I'll do 3 or 4. It's going to have to be very specific. And then I'll be an opportunistic purchaser. Well, as we roll into 2018, it's like this euphoria has built up, and they've actually expanded the number of hotels that they're starting on. Mm-hmm. Even though the last hotel that they did, it was a $15 million hotel, had $2 million in overruns relative to cost. Mm. So their modeling is wrong, and they know it because costs are going up, but at the same time, they're looking to, because they can get access to easy money, they're looking to take what should be lower return investments, and they're not following their own internally developed model. And, that just speaks to me of this, I think that probably they're mistaking the benefits that they've seen from the environment they've been in, the skill, and that's going to catch up with them. Mm-hmm. And, so that you were talking about a gut check. I remember, speaking with the CEO of this company, and I was just like, man, this just doesn't sound right. This guy is smart, he's experienced, but he's forgotten his business has changed. And I got 40 hotels back in 2000, and, during the financial recession, he had 14.
Yeah.
So he's a different company now, but he doesn't remember. He's forgotten that.
Yeah.
So that concerns me. from a gut check perspective,
Yep.
I'm like, if somebody this smart can think that skill alone has gotten them where they are, that just speaks to me of euphoria.
Yeah. Yep. It was oh man, back when I started at Fleet, I got the opportunity to, I think Peter Lynch was managing the Magellan Fund, and had a nice presentation. He's like, kind of, here's my 10 rules or whatever the case may be. One of his first one, or second, whatever, don't try to predict the economy. Don't try to predict interest rates. Never underestimate the importance of management. Know good companies. And it was kind of very simple advice. And it's something that I think I've kept it now. Well, I've actually kind of incorporated I came up it's actually like 12 commandments or something. So this thing has traveled with me for the past 20 years, and I keep it with me. So, earlier I asked the question kind of, what should I be doing? And, should I be, trying to predict where this thing is, where the economy is going? And maybe I should just follow his advice and say, well, don't try. It's impossible, right? Because I don't know. Because I was like with 99.9%. When I went to see Professor Altman, I was like, for sure, I know he's going to tell me what I want to hear. And that was, hey, put on your belts and suspenders because we're in for it. When I heard that guy from Blackstone, for sure I was like, okay, he's going to tell me, put on my belts and suspenders because we're going to be in for it. Sat there. He was moderator. Everything's fine. This credit cycle's different. Nothing keeps me awake at night. I have no concerns. With a straight face. So I keep this list. I keep it by me at all times. And I hold on to it like gold. And I pass it around to the credit associates that come through, and they look at it and they're like, really? I was like, yeah, really. It was interesting because during my kind of doing a little bit of research on UT, and I'm a big hoops fan and I love basketball. When women's basketball started getting kind of really great, who would you see? You would see Pat Summitt. You would see University of Tennessee, right? And she also recruited one of the best women's basketball players ever, Shamika Holtzclaw. She's from Brooklyn. And one of the things she one of her quotes was, don't be afraid to make mistakes because that's how you learn. And my boss came to me one day. He said, look, Gap, kind of when they had the Levi's jeans and everything else, he said, they're issuing a 3-year floating rate note. Should we go ahead and do it? And I was like, yeah, it's right there on Fifth Avenue. I can walk right there. I go in the store. Although I'm not a big fan of Levi's jeans, but I walk in there. I said, yeah, we should do it. No problem. Like 6 months later, then, okay, now the same store sales and all this other crap is going on. CEOs let go. They're changing their marketing strategy, changing their business plan. And all of a sudden, he comes to my office one day. He says, what should I do? Until I get my money back, you're going to give me a report on a weekly basis on Gap. And I was so pissed. So pissed at him. Why is he making me do it? I came home, I complained to my wife. Why is he making me do it? Why do I have to have it? They're good, they're okay. So what if the guy left? They're going through a change. It's okay, it's the gap. I had to do a liquidation analysis. I had to figure out if they defaulted, what was I going to recover? A weekly basis. Every Monday, that was my first job, knowing what was going on with Gap. And I was pissed. But it was the best exercise ever. It taught me a lesson. Taught me a lesson. Now, one of my victories, that was one of my losses. One of my victories was Boeing Capital. He comes into my office, he says, Boeing Capital's issuing paper, I want to buy it. Let me know what you think. You got 5 minutes, because he was getting a call from Goldman Sachs. And I think it was right after September 11th. Did a quick look, said, hey, I wouldn't do it, and these are the reasons why. I think airplane sales are going to go down on September 11th. I don't think air travel is going to blah, blah, blah. And so he doesn't say anything to me, walks out. Not a word. And usually he's like, yes, no, I don't like it, blah, 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 you're full of crap. Walks away, doesn't say anything. So I thought I did something wrong. I said, oh my God, he didn't say anything to me. Next morning, I come in around 7:30. He comes in. He says, before you came into my office, I bought Boeing Capital. I bought the paper. He said, that afternoon, he said, I sold it. He said, I'm glad you did because the price dropped. So just, sometimes, and pretty much Boeing Capital was just, what was my gut telling me about what potentially could happen, what I thought, but it was trusting kind of what I felt inside. Kind of there, I'm a huge fan of KKR and Apollo and those guys. KKR has a very nice business model. They tell you now it's not about the leverage. TPG tells you it's not about the leverage, right? They're looking to generate alpha other ways. Apollo will tell you, nah, we're going to put some leverage on this thing and we think it's a good investment. We're going to do it. No problem. But how much is too much? Right? Everybody knows that LIBOR is going away, right? At some point, and they still don't know what they're going to replace it with. Right? But for now, it's there. And you're right, we have this conversation all the time at work. What happens? Because typically, you're doing bank debt, it's a LIBOR plus. I'm fascinated by the different Bloomberg articles that come out. It's great to be the Treasury Secretary. Everything is fine, right? Everything is fine. Then the next one is very long bull market, right? Pretty cool, right? And then because I'm a member of the TMA, the coming storm. And this really caught my attention. The coming storm. And I'm on the train and I'm thinking, I agree with these guys. Yeah, makes sense. But then I have that same question again. Who's wrong and who's right? Now, I'm going to pick on a couple of people. Not you because you're eating dessert. It's good.
That's my strategy.
Yes. I like this table here. This guy's ready. How are you?
Good.
Nice. Thanks for having me. Appreciate that.
Yeah. Thanks for coming.
You're welcome. So what should I do?
About what? About
What should I do? When I get back to my desk at work on Monday, what should I tell my people? What should I tell my folks? When I sit at my desk and someone presents me with an opportunity to do some bank loan, what should I do? Should I be like, pass? Should I not pass? Should I have any concerns about?
I think the credit crisis or the housing crisis back in '08 probably left a stain on a lot of people's minds, and sometimes, like you said, it's psychological. People are just looking for things that are, going to go wrong, and you can almost kind of create these false illusions that because it's been 10 years since the last recession, that there's automatically going to be one in the near future. But I think, like you said earlier, I mean, if the economics are lining up and you feel pretty good, why not do the deal?
Okay. So you feel like we got another 2 years to go?
You know, it depends on a little bit of this trade war that Trump is kind of accelerated in China. I think a lot of that's still left to play out. With the election and everything coming up in, 2 years? I think it's really hard to tell the future. So
Yeah.
you got to kind of trust the numbers.
I like that. Trust the numbers.
Yeah.
Okay. Cool. What about yourself?
Yeah, I think a lot of it too is kind of even tailing off him is, like this illusion that you're giving to the market and, your peers and everything. Like, I just keep thinking about what you're saying with this chief investment officer of Blackstone, and just how he's just sitting there like everything's fine, I think that, you have to be careful of the illusion you're giving off to people in the market, but at the same time, if the numbers are there and, the analysis is there, basing things off of, what's going to happen, with the election and everything that's going to happen in the next 2 years or so. I think that you have to take it company by company and, what makes sense. Is this the right time to do this deal? And do you trust the numbers? So.
Okay. I already got you already, right?
You did.
All right. I can get you again, though. How about yourself?
I kind of keep hearing you allude to it, but private equity, they're so intertwined, funds and other funds and leverage and rising rates. So, as Connor said, I'm not really overly concerned, but I'm cautiously optimistic or cautious. But I think it's private equity could be a significant downfall. That everything being so intertwined could be a huge negative.
Yeah. And yourself? Go ahead.
I guess we were maybe under the impression that you could come and share with us about, how fixed income analysis can be incorporated with equity analysis to understand a company. So,
Oh.
to hear, your view on that.
I love it. Typically, kind of, if it's a publicly traded company, I want to know what the market is telling me. I think one of the 12 commandments or whatever they are is kind of being able to read the tea leaves. We have these debates or kind of, which one's a leading or lagging indicator. Is it the equity markets? Is the fixed income markets? I will look at both. I will look at where the stock price is trading. I will look at where the bond spreads are. I have, right after, I would say 2009, 2010, around that area, UBS was big into Latin America, particularly Mexico, so we were trying to do a lot with the home builders there. the Mexican government was trying to encourage home ownership. So they were really doing kind of a lot for mortgage origination. So you really had these kind of three big home building companies there. At UBS, I did have trading exposure. We did have some loans, and I noticed that kind of on the Mexican stock exchange, for some of them, for a couple of them, the stock price was kind of trending downward. They did have a couple of U.S. bonds that were outstanding, so I could track the prices, and I noticed the bond spread started to widen out. So I had to make the decision to either do nothing, or as a credit officer, do I cut their credit lines? Do I now say, guys, no more trades? And that's what I did. When I noticed that kind of, widening out in the stock price, I was like, guys, we have to stop. At some point, I think it was maybe 6 to 9 months down the road, I think 2 of them have gone out of business. They filed for bankruptcy. So I use them quite often. I want to know what is the equity markets telling me, and I also want to know, and I can compare, because it gives me a sense of if the company's doing well and if it's not doing well, and whether I need to do something. So I rely on it pretty heavily, particularly on the IG side. I have no problem. I don't think people on the credit side appreciate that enough. I think they kind of focus on fixed income and what's that telling me. I don't think they kind of necessarily take a look and say, okay, well, what's the company's stock price have been doing over the past 12 to 18 months, and do I need to do something? I think it serves as a warning sign, right, for you to do something, right? Put you on alert, because the markets, I think the markets are pretty efficient in that sense, provided things are kind of normalized, right? I like to incorporate that information. The CDS market is not as kind of, in my opinion, not as robust as it was. So the focus now, because we used to kind of, what I would do is I would incorporate kind of where's the CDS price trading? But because it's not as liquid anymore, if they have a publicly traded bond outstanding, I usually try to pick a 5-year. If they have a 5-year benchmark or 10-year benchmark, I look at that, and then I compare that kind of where the stock price is trading. So I do that all the time, right? All the time.
Kind of along those lines, I was kind of wondering what you thought about, thinking about the equity markets and, thinking about fixed income in the context of equity. What do you think about valuations of the equity market, and maybe not just as a whole, but specific sectors of their valuations concerned?
I seem to be kind of, now have more coverage in the automotive space and automotive parts. That's probably one area where valuations concern me, particularly with the auto suppliers. Healthcare seems to have quieted down a bit. I know probably about a year ago, I would say probably on the smaller scale, it seemed like there were a lot more distressed activity going on in that sector. Oil and gas, I can't tell you, because I did a deal in Colombia when gas was about close to $100, and I never thought that it would fall down to 30. So oil, yeah. So I was really, and that deal didn't turn out so good for me. So then I was like, yeah, this is not I don't feel too comfortable kind of in this particular sector. But again, that was a Latin American name, and kind of most of the deals that were done at UBS were reserve-based lending. So yeah, we seem to have did pretty good there. We didn't lose any money.
So at UBS and now at Mizuho, what is the firm view, just in terms of where we are in the credit cycle, and I guess what's the firm view, and then what are you hearing from your colleagues, especially your credit colleagues that are probably more conservative?
I think the firm view at Mizuho is, they feel like this cycle has a little bit more run to it, but I think everybody is pretty kind of on alert, for lack of a better word. People are kind of, particularly on the credit side, are pushing back on trying to push back on terms. At UBS, before I left, they were very aggressive, kind of getting back into building up their leverage finance business. So they didn't mind kind of stretching the needle a little bit. Not as aggressive as Credit Suisse and some of the other larger firms, but definitely kind of on the margin, taking a little bit more, which for a conservative shop like UBS was, kind of a little bit odd. But again, you have to compete, right? And it's all about those deal mandates that come through, and you being able as a investment banker to bring those deals in. Any other questions?
That's it.
I'll do one more. So you said you were in the auto sector. I guess they've had me thinking about trade. And when you've got a sector that's really sensitive to trade deals, or I guess how are you evaluating our country's trade policy when it seems like maybe the administration doesn't necessarily know what they're going to do? You know what I'm saying?
Yeah.
As far as, are you guys optimistic about trade with China happening at some point, or trade with Europe, or those kind of deals?
Well, I can tell you my opinion. I don't think these trade wars or trade, whatever you want to call it, with China can be good. It's a good outcome for us. I think there's too much at stake. I think there's a lot that we rely on China for. And I think ultimately it comes back and it hits the consumer's pocket, right? We'll pay for it some way or another. My own opinion is I just wish it would quiet down. I just wish it would be quiet. There's ways to negotiate. I'm a firm believer of let's sit down, let's talk. We can have disagreements. We can disagree to disagree, but we should talk and not. I think the old way of it's my way or the highway, as my grandfather used to say, it doesn't work anymore, right? I can see it working with my younger colleagues. They want to be engaged. They want to be taught. They want to be educated, right? And typically when I was negotiating a trading agreement with a counterparty, I would tell the guy on the sales and trading desk, it's very easy for me to say no, but it serves the client and it serves you no purpose, and it serves the firm. Let me understand where you're coming from. If I can sit down and understand where you're coming from, then I can explain, okay, my position, and let's see where we can meet in the middle, because we both have to make it work. It's not, where everyone's in isolation. This is a global economy. The things we did 50 years ago doesn't work, right? We all have to, let's say, get along, because there's money to be made for everyone. I don't have to, beat the hell out of her to make more money for him. We can all win. It's just finding that win, right? So the stuff that I hear coming out of the president and even on the side of the Chinese, and it's just kind of tit for tat, to me doesn't make sense. It doesn't work, and it's not going to work. It's not going to end pretty for us. Good? Thank you.